Hello, and welcome to another session of Stop, Look, Listen, and Learn. Today, we're going to talk about options. We're going to have a brief introduction. An option is simply a derivative, and a derivative is a contract that derives its value from price fluctuations of an underlying asset. That underlying asset is referred to as the underlying, and it can be a stock, a bond, an interest rate, volatility, the weather, pretty much anything that has some volatility can be an underlying. With respect to options, there are fundamentally two types of options. There is a call option and there's a put option. The call option gives the owner or the person who purchases the option the right, but importantly, not the obligation to buy the underlying at a fixed price that is referred to as the strike price. And the strike price stays constant throughout the term of the call option. The person purchasing the call option will pay a premium to the seller of the call option, and the premium is paid to compensate the seller for assuming certain obligations associated with the call option. A person buying a call option has a bullish outlook. In other words, they believe that the price of the underlying will rise in the future. And they will profit if the price of the underlying increases above the strike price. So you can see the payoff profile here. Initially, you start off in the red because you have to pay the premium for the option. But as the price of the underlying increases, you can see that you start to move closer to break even. And once you recoup the cost of your option and the price continues to increase, then you can see that you make profits. And the profits are represented by the green line here. And the profits, in theory, are unlimited. They could go to infinity depending on how far the price of the underlying increases. Now, when you purchase an option, you purchase it from a seller, and the person selling the call option is said to have a short position in the call option. And when a person sells the call option, they assume an obligation to sell the underlying at the strike price. So if the person who owns the call option decides that they want to exercise their right to purchase the underlying, then the seller will be obligated to sell the underlying to the owner of the option, and the seller must sell the underlying at the strike price. The seller receives a premium as compensation for assuming that obligation, because that obligation would require the seller to sell at the strike price, regardless of what the market price of the underlying may be at the time that the owner of the option exercises the option. And in fact, the owner of the call option will not exercise the call option and purchase the underlying at the strike price unless the price in the market for the underlying is above the strike price. So the person selling the call option will have a bearish outlook, and they will believe that the price of the underlying will remain constant or will decrease in the future. And so as you can see here, this vertical bar here represents the strike price. The seller receives the premium, and as long as the price of the underlying remains equal to or less than the strike price, then the seller of the option will retain 100% of the premium or maximize their profit on the sale of the call option. But if the price of the underlying starts to increase, then you can see the increase in the price of the option will begin to erode the profits that the seller made by selling the call option. And if the price continues to increase, then the seller of the call option will start to incur losses. And the amount of losses that the seller of the option realizes is going to be pretty close to the amount of profits that the owner of the option realizes. And so if you look at the payoff here with respect to the owner of the call option or the person who has the long position, their payoff would be the maximum of the difference between the price of the underlying in the market and the strike price, or zero. So whichever is the greater of those two numbers, that's what their payoff will be. The important thing to note here is that the owner of the option does not have the obligation to buy. So if the strike price happens to be above the market price, meaning that there would be a loss if he were to purchase the underlying at the strike price, then they will not exercise the option and they'll just simply lose their premium. So the payoff here is asymmetrical, as you can see. So the downside is limited to the amount of the premium, but the upside is unlimited. Now, looking at the short side of the call option, the payoff here is also asymmetrical as well, because the profits is capped at the amount of the premium, but the losses can be unlimited in theory, because the price of the underlying can increase to whatever number is going to increase to. And as it continues to increase, the losses will continue to accumulate. And so you can see here, the payoff is exactly the opposite of what the payoff would be to the person holding the long position in the call option. Now, the other type of option is a put option, and the put option gives the owner or the person who purchases the put option the right, but again, not the obligation to sell the underlying at the strike price. And again, the purchaser of the put option will pay a premium to the seller of the put option to compensate the seller for assuming the obligation to buy the underlying in the future if the owner decides to exercise his or her right to sell the underlying. Now, a person buying a put option will have a bearish outlook. In other words, they'll believe that the price of the underlying will be declining in the future. And as the price of the underlying declines below the strike price, the owner of the put option will generate profits. And you can see that from the payoff here. Again, initially, the purchaser of the put option will start off in the red because they have to pay the premium, which is going to be an outlay at time zero. But if the price of the underlying declines, then those losses start to erode and they get up to break even. And then if the price of the underlying continue to decrease, then they make more and more profits as the price continues to decrease. Now, the profits are capped here because the price of the underlying can go down to zero, but no further. So the profits will be maximized when the price of the underlying goes to zero. And the profits that the owner of the put option will realize would be equal to the strike price less whatever the premium is that they paid for the put option. On the other side is the person who has the short position in the put option, And again, when the person sells the put option or takes a short position in the put option, they assume the obligation to buy the underlying at the strike price if the owner of the put option decides to exercise his or her right to sell the underlying. And again, the person with the short position in the put option will realize losses because they will have to purchase the underlying at the strike price, and the market price of the underlying will be below the strike price, because otherwise the owner of the put option would not exercise the put option. And because of that obligation slash risk, the seller of the short option has to be compensated, and they receive the premium from the purchaser of the option to compensate them for assuming that liability. And a person selling a put option would have a bullish outlook, meaning that they would believe that the price of the underlying will remain constant or increase in the future. And if you look at the payoff profile here, the green portion of this line here is as long as the price of the underlying is equal to or greater than the strike price, then the seller of the put option retains 100% of the premium that they receive, and they maximize their profit on the sale of the put option. However, if the price of the underlying starts to decline below the strike price, then the profits that the seller of the put option earn from the premium would start to be eroded. And at some point, they'll reach break even, where the profits from the premiums will be completely offset. And if the price of the underlying continues to decline, then the losses will start to accumulate. Now, the seller of the put option, their losses are capped because, again, the price of the underlying can go down to zero, but it can't go below that. So if the price of the underlying were to go down to zero, then the maximum loss that the seller of the put option would realize would be equal to the strike price, because they would have to pay the strike price when the owner of the put option exercises the put option, but the price of the underlying would be zero. So that's what their loss would be. Now, if you look at the diamond down here, I just kind of summarized everything so that you can get a pretty good sense of what the payoffs would be and what the underlying motivations would be for taking a long position or short position. So if you look at this vertical bar here, we'll start here at zero, and profits are going up, and then losses are in the downward direction. So if you're long a call, that means you're bullish. And as you can see here, as the price of the underlying increases, you make profits. And if you are short a call, then you are bearish, because as you can see here, as the price of the underlying increases, you're going to sustain losses. But if the price of the underlying decreases, you will generate profits. And then, of course, your profits will be capped at the amount of the premium that you received when you sold the option. On the other side, if you have a long position on a put option, then you're going to be bearish, because if the price of the underlying decreases, you can see that your profits increase as the price of the underlying decreases. And if the price of the underlying increases, then you'll sustain losses. And if you have a short position in the put, then you have a bullish outlook, meaning that you believe that the price of the underlying will remain stable or it will increase, because as it increases, as you can see, you'll maximize your profit, which would be equal to the amount of the premium that you received when you sold it. But if the price of the underlying were to go in the opposite direction and decline, then the profits you made from the premium would be eroded. And if the price declines further below the strike price, then you'll start to sustain losses. And as we said earlier, the maximum loss you can sustain from a short position in the put would be equal to the strike price. Now, that's a high level overview of call and put options. And if you understand this, then this will help you on the exam because you'll be able to very quickly understand what the payoffs are going to be and what position you should take, whether you should take a long position or a short position, and whether that should be a call option or a put option. In subsequent videos, I will look at how we go about determining what the amount of the premium should be that the purchaser of the call option should pay to the seller of the short, to pay to the seller of the call option. And the same thing for the put option. How do we go about determining what that premium should be? Or in other words, how do we price an option? So with that, I'll conclude this video. Hopefully you found this helpful. If you did, please don't forget to subscribe to our channel and keep an eye out for the subsequent videos where we continue our discussion of options. Thank you.